Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're focusing on the new Canadian mortgage rules that just came into effect on December 15th. These changes, announced by the federal government back in September, aim to make home ownership more accessible, especially for first-time buyers, including millennials and Generation Z. Let's break down what these new rules mean for homebuyers in Ontario. Firstly, the federal government has increased the price cap for insured mortgages from $1 million to $1.5 million. This change is significant because it allows more homebuyers to qualify for a mortgage with a down payment of less than 20%. Previously, homes priced at $1 million or more were not eligible for mortgage default insurance, but now, with the raised cap, buyers have more options. For instance, the minimum down payment on a $1.4 million home could potentially be up to $165,000 lower, which is a substantial saving. Another major change is the expanded access to 30-year mortgage amortizations. Now, first-time homebuyers and buyers of new builds, including condominiums, can opt for a 30-year amortization instead of the usual 25 years. This extension allows buyers to spread their payments over a longer period, reducing their monthly financial burden. Although it's important to remember that this will result in higher interest payments over the life of the loan, it does provide more immediate affordability for those entering the market. The Canadian Mortgage Charter also plays a role here. It allows all insured mortgage holders to switch lenders at renewal without having to undergo another mortgage stress test, provided they maintain the same loan amount and amortization period. This flexibility can lead to significant savings and make it easier for homeowners to find better mortgage terms when renewing. Speaking of the mortgage stress test, there have been updates there as well. If a homeowner with an uninsured mortgage is switching lenders and keeping the same loan terms, the new lender won't be required to apply a new stress test. This is known as a straight switch and can be a game changer for those looking to refinance or find better rates without the hassle of additional testing. Lastly, let's talk about the impact of recent interest rate cuts. As of December 11th, the Bank of Canada has reduced its overnight lending rate to 3.25%, marking the fifth consecutive cut. This reduction has lowered the prime lending rate to 5.45%, which in turn affects variable mortgage rates. For those with variable rate mortgages, this means either lower monthly payments or more of their payment going towards reducing the principal balance. This is a crucial development for anyone currently in or considering a variable rate mortgage. National home sales have continued their upward trajectory, with prices rising amid falling interest rates, according to the latest report by the Canadian Real Estate Association. The number of homes sold in November increased by 26% compared to the same period last year, marking the second consecutive month of significant year-over-year gains. A total of 37,855 homes were sold across Canada last month, up from 30,042 in November 2023, following a 30% year-over-year sales increase in October. This surge in sales activity is largely attributed to the easing of interest rates by the Bank of Canada. Last week, the central bank implemented a half percentage point cut, marking the fifth consecutive reduction since June, bringing the policy rate down to 3.25%. According to Mike Heddle, a broker for Royal LePage State Realty in Hamilton, Ontario, this policy shift has instilled a bit more confidence in both first-time buyers and those looking to move up in the market. The Canadian Real Estate Association noted that the increase in home sales was driven by significant gains in regions such as Greater Vancouver, Calgary, Greater Toronto, and Montreal, as well as smaller cities in Alberta and Ontario. The national average sale price for November rose by 7.4% compared to a year earlier, reaching $694,400 $411. Sean Cathcart, the association's senior economist, mentioned that while sales were up, the tightening of market conditions led to a notable increase in prices at the national level for the first time in nearly 18 months. Typically, one might expect the market to take a pause before picking up again in the spring. However, Cathcart suggested that the recent 50 basis point rate cut by the Bank of Canada, along with relaxed mortgage rules, might result in a more active winter market than usual. On a seasonally adjusted month-over-month basis, national home sales rose by 2.8% from October. Meanwhile, the number of newly listed properties decreased slightly by 0.5% month-over-month, with over 160,000 properties listed for sale at the end of November. Although this is an 8.9% increase from last year, it remains below historical averages for this time of year. According to Mike Heddle, there is a stronger sentiment among buyers now than in recent months, although affordability continues to be a significant challenge. Clay Jarvis, a spokesman for NerdWallet Canada, pointed out that with variable rates decreasing and inventory rising, buyers are keen to enter the market before prices potentially increase further. Jarvis anticipates a competitive spring market, prompting some buyers to act now to avoid higher costs in the future. He described this decision as an opportunity cost, where buyers might pay a little more for their mortgage today, but save on home prices later. The market is expected to end the year on a high note, with Jarvis emphasizing that while the frenzy of December 2021 is unlikely to return, significant sales increases compared to last year are anticipated. These developments suggest a dynamic and evolving real estate landscape as we move into 2025. Today, we're diving into the recent developments from the Fall Economic Statement, which was delivered amidst a day of political upheaval in Ottawa. The statement, which was initially to be presented by Finance Minister Chrystia Freeland, proceeded despite her abrupt resignation. This fiscal update has outlined a projected deficit of $61.9 billion for the current fiscal year, significantly higher than the previously forecasted $40.1 billion. While the fiscal pressures were a major focus, housing policies took center stage, with several new initiatives being highlighted. One of the key announcements from the Fall Economic Statement is the removal of the stress test for low-ratio insurable mortgages when switching lenders at renewal. This aligns federal rules with the Office of the Superintendent of Financial Institutions' recent decision to remove the stress test for uninsured mortgage renewals. The government is also planning to review and consult on potential improvements to the stress test for insured mortgages. However, given the political turmoil and the possibility of a non-confidence vote, there is uncertainty about these new measures being implemented. In response to the political climate, New Democratic Party leader Jagmeet Singh has called for Prime Minister Justin Trudeau's resignation, indicating that all options, including a vote of non-confidence, are on the table. NDP House Leader Peter Julian has stated that if Trudeau hasn't resigned by late February or early March, a vote of no confidence could be pursued. Amidst this backdrop, Ron Butler, a mortgage industry expert, expressed skepticism about the new announcements coming to fruition, suggesting that any non-scheduled rule changes or projects that haven't started might not proceed under the current government. Additionally, Housing Minister Sean Fraser has announced that he will not seek re-election, adding to the list of Liberal ministers stepping back from politics, which further fuels the speculation of a potential election. Despite these challenges, the Fall Economic Statement introduced several housing measures aimed at improving affordability and supply. Notably, the stress test removal for insurable mortgage switches at renewal is a significant step, aligning with OSFI's rule for uninsured mortgages. This exemption applies to portfolio insured mortgages, which are often used by lenders to bulk insure low-ratio loans for securitization. Another promising initiative is the government's exploration of long-term fixed-rate mortgages in Canada. While Canadian lenders can technically offer long-term mortgages, they are not commonly chosen by borrowers, who typically opt for terms of 5 years or less. The government plans to launch consultations to examine the barriers to offering these long-term options, similar to the 30-year fixed-rate mortgages available in the United States, which offer predictable payments over a longer term. Other housing updates include the doubling of loan limits for secondary suite programs to $80,000, with loans offered at a 2% interest rate over a 15-year term. Additionally, the government has launched consultations on curbing corporate purchases of single-family homes, aiming to assess the impact of investor activity on housing affordability. Feedback from Canadians, provinces, territories, and stakeholders is being gathered until December 19, 2024, with further details expected in Budget 2025. The federal government is also advancing its plans to combat mortgage fraud through improved income verification processes. The Canada Revenue Agency is working with experts and mortgage lenders to design a secure and user-friendly tool to help financial institutions detect fraudulent activity, with implementation set to begin in early 2025. Moreover, the Fall Economic Statement has allocated additional funding to the Greener Homes Loan Program, adding $600 million to support an additional 15,000 to 24,000 homeowners. This initiative aligns with Canada's goal of achieving net zero emissions by 2050, offering interest-free loans of up to $40,000 over 10 years to help homeowners reduce energy costs. Lastly, the government reported that nearly 1 million Canadians have opened a tax-free first home savings account since its launch in 2023, allowing first-time homebuyers to save up to $40,000 tax-free for a down payment. This program provides a significant boost for those looking to enter the housing market. Canada's housing market demonstrated remarkable strength in November, with housing starts increasing by 8% to a seasonally adjusted annual rate of 262,443 units. This data, released by the Canada Mortgage and Housing Corporation, highlights a robust performance that exceeded economists' forecasts and marked a significant improvement from the previous month's figures. The growth was primarily driven by multi-unit projects, notably in Quebec, Alberta, and British Columbia, where urban centers saw a pronounced 11% rise in multi-unit starts, including condominiums and apartments, reaching 195,281 units. Single-detached urban starts also experienced a modest 4% increase, totaling 49,802 units. This surge in November has contributed to a year-to-date total of 210,912 housing starts, representing a 3% increase over the same period last year. Mathieu Laberge, the chief economist at the Canada Mortgage and Housing Corporation, highlighted the regional disparities that are fueling this growth. He noted, "While Alberta, Quebec, and the Atlantic provinces are still pushing the national year-to-date starts higher, Canada still needs major increases in supply growth to restore affordability in our urban centers." Despite the monthly increase, the 6-month trend in housing starts showed a slight decline of 0.3%, bringing the total to 243,268 units in November. This trend measure is significant as it provides a more comprehensive view of the market, suggesting an underlying stability in the housing sector. The recent interest rate cuts by the Bank of Canada seem to be revitalizing the housing market, which had previously shown signs of slowing down. With inflation aligning with the central bank's 2% target, this uptick in housing starts could indicate a broader economic recovery, offering a glimmer of hope for Canada's housing sector. A recent survey conducted by Abacus Data in collaboration with prominent housing organizations such as the Canadian Real Estate Association and the Canadian Alliance to End Homelessness has shed light on the profound impact of Canada's ongoing housing crisis. The survey reveals that housing affordability issues are not only straining Canadians' finances, but also affecting their mental health and family dynamics. The survey found that nearly 43% of Canadians are experiencing increased financial stress due to the housing crisis, a figure that has grown over the past year. This stress extends beyond financial concerns, as 35% of respondents report a decline in their quality of life, and 33% are facing mental health challenges directly related to housing difficulties. Particularly hard hit are younger Canadians, aged 18 to 44, who are encountering disruptions in family life, postponements in plans for children, and the stress associated with potential relocations as housing costs continue to escalate. The report underscores that housing issues have transcended the realm of market concerns and have become significant life issues for many Canadians. The survey also highlights the growing anxiety over housing security, with over 58% of respondents expressing worry about affording their mortgage or rent. This concern is more pronounced among younger and lower-income Canadians. For those aged 18 to 29, 68% are anxious about meeting housing costs, while 71% of individuals aged 30 to 44 share similar fears. This anxiety is particularly acute in high-cost regions such as British Columbia and Ontario, where more than 60% of residents fear financial instability could lead to losing their homes. Homeownership continues to be a deeply held aspiration for many Canadians. However, it is increasingly seen as an unattainable goal, especially for younger generations. Among non-homeowners, 72% aspire to purchase a home, yet nearly half, 45%, feel pessimistic about realizing this dream. This sentiment is echoed by 41% of those aged 18 to 29, who, despite holding on to hope, acknowledge that their optimism is diminishing as housing prices rise and savings fall short. In response to these challenges, some Canadians are exploring alternative housing solutions. Options such as rent-to-own programs, tiny homes, and cooperative living arrangements are gaining traction, particularly among younger individuals and urban residents seeking viable options in an increasingly unaffordable market. The report emphasizes that addressing these housing challenges is crucial for restoring balance and security within Canadian communities. As we look ahead to 2025, there's a growing conversation around the potential resurgence in popularity of variable rate mortgages in Canada. This shift comes after borrowers largely turned away from these options in 2022 and 2023 in response to the Bank of Canada's series of interest rate hikes. During that period, many Canadians opted for fixed-rate mortgages to avoid the fluctuations tied to the central bank's rates. According to the Canada Mortgage and Housing Corporation, shorter-term fixed rates became the preferred choice for many as homeowners sought stability amidst rising rates. TD Bank reported that a significant portion of mortgage holders, about 14% of the $520 billion in variable rate mortgages, either prepaid or refinanced into fixed rates by the end of 2022. This was a strategic move by borrowers to front-load the payment shock and lock in their rates. However, with the central bank shifting to a rate-cutting stance in 2024, reducing rates by a total of 175 basis points, borrower sentiment appears to be swinging back towards variable rates. Newfoundland-based broker Robert Jennings from East Coast Mortgage Brokers has noted that the prospect of further rate cuts in the coming year could make 2025 a pivotal year for variable rate mortgages. He anticipates a competitive environment, especially concerning mortgage renewals and refinances. Jennings described the upcoming year as potentially the year of the variable rate mortgage, pointing out the narrowing advantage of fixed rates over variable rates. Although fixed rates have also decreased since June, the Bank of Canada's recent cuts have significantly reduced the gap between the two types. This trend is expected to continue, with further rate reductions likely as the central bank navigates economic uncertainties, including potential tariffs from the United States. The Bank of Canada's governor, Tiff Macklem, has expressed concerns over the incoming U.S. administration's proposed 25% tariff on Canadian goods, describing it as highly disruptive. This development adds another layer of complexity to Canada's economic forecast and could influence interest rate decisions further. Former Deputy Governor Paul Beaudry suggested that policymakers might continue cutting rates until the key interest rate falls to 3.75%. This potential decline could further bolster the appeal of variable rate mortgages for Canadian borrowers. Meanwhile, Robert Jennings raised questions about recent federal government financial giveaways and their impact on the economy. He noted that such measures could be inflationary and complicate the central bank's efforts to achieve a soft landing for the economy. Jennings emphasized that economic cycles are natural, and while we're on a downward trend now, these cycles eventually lead to recovery. As we move through the winter months, potential homebuyers in Ontario might find some opportunities with lower prices across the province. Winter is typically a slower time in the real estate market, with fewer listings available. While some areas in the Greater Toronto Area have experienced recent price increases, the overall market remains sluggish. According to the Toronto Regional Real Estate Board, the average selling price in November rose by 2.6% compared to a year earlier, reaching $1,106,050. However, home prices are still well below their historic peak, as noted by Board President Jennifer Pierce. Despite the potential for a market recovery in 2025, many sellers are currently lowering their prices. Real estate brokerage. Zoocasa has highlighted several properties that have recently seen price reductions. Let's take a look at 5 homes in Ontario that have experienced price drops. First, we have a 3-bedroom home located at 580 King George Street in Peterborough. This property is situated in a peaceful neighborhood in Peterborough's South End. It features a fully fenced yard, a detached garage, a covered porch, and an open-concept living and dining area. The home also boasts new vinyl flooring and an electric fireplace, along with a fully finished basement. Originally listed for $569,000 in the summer of 2023, the asking price has now been reduced to $525,000. Next, there's a 1-bedroom condo at 1816, 480 Front Street West in Toronto. This luxury condo, located in the new Toronto development known as The Well, has seen a price drop of $50,000. Now listed at $999,000, it includes a den and a balcony with an unobstructed view. The building offers amenities such as a state-of-the-art gym, an outdoor pool, a barbecue area, and a 24-hour concierge service. Another property is a 3-bedroom home at 269 Court Street in Oshawa. This 1.5-story detached home sits on a large corner lot and features a large detached garage, complete with heat and power, making it ideal for use as a workshop, hobby space, or extra storage. Originally listed for $599,900 in the summer, the price has been reduced to $525,000. The home is conveniently located just minutes from downtown Oshawa. In Mississauga, a 2-bedroom condo townhouse at 5625 Oscar Peterson Boulevard has also seen a price drop. Located in the Churchill Meadows area, this newly painted corner unit offers plenty of natural light and features balconies on both the main and lower floors. The property was initially listed for $699,000 in June, but the price has been adjusted to $649,990. Finally, there's a 2-bedroom home at 177 Durham Street in Kincardine. This home is near Kincardines Dunsmore Park, the historic Kincardine Beach Pavilion, and the famous Rock Gardens. Originally custom-built as a beachside family retreat, it can serve as a year-round home, investment, or retirement property. Initially listed in November 2022 for $824,900, the price has been reduced several times, now standing at $679,900. In Toronto's bustling real estate scene, Property.ca has made a significant move by launching the Boulevard branch, its latest addition to the city's vibrant market. This expansion marks another step in Property.ca's strategy to enhance its presence in key urban areas, providing comprehensive real estate services to a growing clientele. The Boulevard branch is strategically located to serve both residential and commercial clients, offering a range of services that include buying, selling, leasing, and property management. This new branch aims to capitalize on the increasing demand for real estate in Toronto, driven by the city's strong economic fundamentals and diverse population. According to Property.ca CEO, the decision to open the Boulevard branch was driven by the need to be closer to clients and offer personalized services tailored to the unique characteristics of Toronto's diverse neighborhoods. The branch is expected to provide clients with deeper insights into the local market, helping them make informed decisions backed by the firm's extensive experience and data-driven approach. The opening of the Boulevard branch also reflects Property.ca commitment to innovation in the real estate sector. By leveraging technology and digital tools, the branch aims to streamline the real estate process, making it more efficient and accessible for clients. This includes the use of virtual tours, online consultations, and advanced data analytics to provide a seamless experience. As Toronto continues to grow and evolve, Property.ca expansion with the Boulevard branch positions the company to better serve the needs of both current and future residents. With a focus on community engagement and sustainable practices, the branch is set to become a pivotal part of the local real estate landscape. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time and stay informed with the latest industry insights.